All right, good morning. Welcome back here to Trader Minute. Great to have you aboard. Yesterday we went out and we took a look at the the stochastics, and kind of what was the idea behind that. How George Lane in the '50s kind of developed that for to be a momentum oscillator. Yeah, nowadays it's kind of used as a high-low oscillator incorrectly, but showed how to kind of look at it from a momentum standpoint. Even showed how a lot of stocks were changing their momentum right now, based on the kind of the 39-day stochastic. So a very important indicator. Today, I want to go out and take a look at the RSI. Not because I love the RSI, not because I think the RSI is a fantastic indicator. In fact, I think it's kind of a ho-hum indicator. It's not one I use very often. I'll show you how I use it. But the next several indicators we are going to go look at are all developed by a gentleman named Welles Wilder. And these indicators were developed and published back in kind of the early 80s, late 70s. I believe the RSI was published in about 1978 there. But Wilder was a very interesting market technician. And he's one of my favorites. Because he understands or understood that when it comes to trading the markets and using charts, it wasn't about, well, do X, Y, and Z right here, and A, B, and C right here, and do this and do that at all these different points. He realized that when he added statistical measures, which is what a technical indicator is, when he added statistical measures to the price data, it told him a story. And so he created several indicators to tell the story. He created the average true range. He created the average directional movement, the ADX, right? We're going to go look at both of those in the coming days. He was the developer of the parabolic SAR. Not my favorite indicator, not something I ever use, but he took and he looked at the data and he tried to develop indicators to tell different stories around what was happening in the price action. He knew that one indicator didn't cut it. What's really interesting is he developed indicators that told very different stories. Right now, you see people with their charts, they'll go put on 4 different indicators that all tell the same story. Right? They're all looking at the same thing. They're all just calculating just a little bit different. Well, what good does that do? Not a whole lot. But Wilder understood this concept of technical analysis telling the story of a chart of a stock, and that you could kind of use this to trade effectively. Now, he also commented that if you gave him the relative strength index, the RSI, and the price of the stock, the data of a stock, something like this, he would not be able to trade effectively. Which is one of my favorite comments from him because it showed a respect for technical analysis and what it really is. And it showed that one indicator doesn't cut it. That to look at the RSI and say, well, you know what, buy here, sell here, do this, do that, alone wasn't good enough. You need more. You need more to the story. And as we go through these 30 indicators, right, we're going to go afterwards and we're going to take and put together indicators. We're going to look at indicator combinations that start to tell stories. Wilder was the first person to start to do that, to put together various indicator combinations. And so understanding his indicators, understanding how they're put together, it is a real good insight into, the early evolution of technical analysis and what is used effectively by trade algorithms and whatnot here today. Let's go out and take a look at the RSI. Very simple looking indicator. Has this scale over here from, basically 100 to 0, right? Above 70 is considered overbought. Below 30 is considered oversold. And you're going to hear me say this many times in the coming days. Overbought doesn't mean sell. Oversold doesn't mean, buy. but overbought, oversold, are the indications, 30 and 70. And there are several different ways to use this indicator. One of the more common ways, and perhaps the most simplistic and most useless way to use it, is just looking at 50 and saying, well, when it's above 50, you buy, and when it's below 50, you sell. You don't have to look at a whole lot of, very many RSIs to understand there are a lot of whipsaws in that. It can get ugly real fast. And if you're an option trader buying and selling on moves on the RSI above and below 50, you're looking for a new indicator real fast. It also doesn't take long to say, hey, if you're selling or buying a stock when the RSI is below 30, you're not having a good time either. If you're selling when it's above 70, you're not having a consistent good time either, right? You're kind of, wandering in the dark, just kind of some arbitrary numbers here and not really getting what the story is with the stock and how it, ultimately trades. But the RSI does have a little bit of magic to it. It does have a little bit of consistency to it in a few things that, are less watched or less, observed, but, have some, real nice accuracy points to them. One of them is to look for levels in the RSI, right? So, for example, here we go. We have, these two peaks right here in the RSI, right? They're creating this level. So, you drag this out and you say, okay, if we get a move to where the RSI moves above these levels, we're seeing additional relative strength coming in to the stock. And so you can look for levels. Most stocks, they don't have good levels associated to them. And, you'll see traders and whatnot, they'll put the RSI, they'll draw these lines and show the breakouts or the breakdowns, that will happen in those. And I've never found that to be too effective. It really works nicely if you're trying to look in hindsight, if you're looking in the past history of a stock, if you're looking and saying, hey, you know what, let's go model the RSI with that stock. Yeah, it works. It works in hindsight. In current time and say, well, what does this reading mean right here, right now? It's way more ambiguous and, in my opinion, absolutely useless. Right? Absolutely useless. So I don't do it very often. But you're going to see it. You're going to see trends. Here we go. Here's the RSI trend. All right, when that trend breaks, you sell the stock and you move on. And all right, well, you sell it just for the stock to go to a new high. It follows the stock too closely for me to find any value in that. If I'm going to be that simplistic, I might as well just go out and say, oh, okay, here we are. We have these two tops right here. If we break that, then buy, right? Or here we have the lows. Okay, if we break those, you sell. I could simply do that same strategy just looking at the actual price action. I don't need a convoluted indicator to, tell me that. But where the RSI shines is when we're talking about divergences, where the indicator is doing something different than the stock. When the indicator is at levels that are different than the stock. Here's Caterpillar. RSI on Caterpillar right back here is the same level as the RSI right up here. We have a stock that's trading significantly higher while the RSI is not. That's weakness. That is a negative type of divergence. Now, that's not the way most people are going to look at divergences, but for me, when I look for the RSI and divergences, I just look at levels that are the same and see where that stock price is. Is that stock price at the same level. So let's go kind of use CAP for a few examples here. And I'm going to draw some vertical lines so we can see exactly what's going on. But here we have the RSI making a peak, right? Right back here in February. You'll notice the RSI retests that peak as the stock goes higher. Let me make these lines a lot thinner here. There we go. That way we can still see the price action. There we go. All right. And so we come in and we start to mark these levels where the RSI made these peaks. Now the stock surges. RSI same level. Stock goes and hits a new high. RSI just slightly higher. Just slightly higher. Okay. All right. So, we see the RSI kind of dancing around this level as it hits highs. But what about as it hits lows? Let me just make these lines a little different color here. Let's just black them. Take a look at this low right here and where the RSI was. Now take a look at this low, which is the exact same price low from weeks prior, and look at where the RSI is. The RSI has some negative divergence. We have the stock hitting the same levels, but greater weakness in the indicator. Divergence is looking for spots where the indicator and the stock price are doing something different. And that is where the RSI shines in showing divergences. Now, one of the more famous divergences when it comes to the RSI is referred to as a failure swing. And I'll admit, these are what I look for mostly. I'm not really, looking too much at, well, do we have a divergence here and all of that. I'm not in cat puts right here because of this divergence, right? I don't need the indicator to show me that. I see the lower high here. I see it bounce back to the 7. I see the weakness come in. Great. I can run with it. But something like this up here, September and October. Stock boat races higher. RSI goes and gets overbought. And that's key number one. If we're going to talk about a failure swing, we're going to talk about negative divergence, but we're going to talk about it happening in an overbought condition. So that's number one. You need an overbought RSI. Easy enough, simple enough. Overbought RSI. Number two, you need for the RSI to pull back below 70. Okay. So stock price pulls on back. Just a normal little pullback. Nothing too alarming. Nothing too out of the norm. So we get this move above 70. We get the move back below 70. And then number three, we get back above 70 again. And this time, the stock price hits a new high. But the RSI does not. Negative divergence. At this point, we're set up for a potential failure swing. It doesn't always happen, but the setup is here. Where do you say, okay, you know what? This is where you short it. This is where you sell. This is where you say enough, if you're long, enough is enough. If you're looking to go short, time to go. Well, when the trough of the RSI gets broken, we have a negative divergence in the stock, and now the RSI breaks the low from what it was on the last pullback. Sometimes that happens with the stock price higher. Sometimes it happens with the stock price lower. But on this trough break, there's the time to sell. There's the time to get bearish and say, yep, enough's enough. Move on. If we come in and we just look at, if we just look back here, you could see that if we were to treat 50 like 70, we have a failure swing. Failure swing in terms of the RSI. But we don't have the stock price hitting a new high on this failure swing. So it's a little different dynamic, right? But these failure swings, they don't happen often. But when they do, they're very accurate. They're one of my favorite things to look at and look for. But I don't really look for them in daily charts. Doesn't matter to me too much in daily charts. We're going to have other metrics that are going to kind of show better what's going on. But in hourly charts, these set up very nicely. These hours, or when we go and we take an hourly chart and look at these divergences here, or these failure swings here, when it comes to the RSI, it's the right area to use it. It's the area where we're going to get more indications. It's the area where the indications are going to be a lot more tradable, right? And it's going to be an area where where it makes more sense for an option trader to use. Now, here's Caterpillar. We don't have any real failure swings, associated, right here in the upside of the RSI. Brief, barely one right here. So technically one right here on the 18th. Right, where we have a failure swing. Let me just scroll up to see the price action. So here we have the RSI hitting a new, or not hitting a new high as the stock hits a new high, and then the RSI breaking below that, or this trough level right here. Right, so right here, this is the short, this is the short area. Great. Not going to call the top or anything like that, but it tends to be fairly accurate. But we can also play this on the other side, right? We can look for bullish failure swings. So right back here we go. We move below 30, right? We become oversold. Okay, easy enough. Well, now we just take the bearish failure swing and put a bullish context to it. Where's our midpoint? Where's the level right here? This is the level that it rallies to and goes above 30. Now you'll notice it dips back below 30, but never rallies back above this key level right here. So there's no buy signal, no buy signal. The buy signal is still possible because we haven't taken out the low from the RSI. And now the RSI breaks this kind of rebound area right here. That's the buy point there on Caterpillar. Right? Now I show this. Why? Had a failure swing. But, if you're trading options on it, it's not like it's going your way right away, and trending huge, right? The RSI is still strengthening. It's strengthening. It's strengthening. But, your option is, depending on which one you chose, you're not exactly, bragging about the mint that you made, right? When it comes to using this average true range on an hourly, you have to be patient through the oscillations, and your stop level becomes a breakdown back below this RSI level. That's where you say enough's enough. So back here, if you short it, right? If you short it right here on the 18th, great. If the RSI, you're going to have rallies that happen. If the RSI breaks back above this level, that's where you've got to be out. That's where you have to say enough is enough. Outside of that, you can hold on, and the RSI failure swing is still in play. Now, I do like the RSI failure swings for entries. I absolutely hate the RSI for exits. Anything exit related, I think the RSI is absolutely worthless. And, I wouldn't even consider an RSI reading to suggest an exit point here for me on any trade, anytime. Just isn't something that I care to use. Not something I've ever seen used effectively for exits. And, we'll talk about better indicators for exits, things like a money flow index, even the parabolic SAR that Wells Wilder used. And, we'll go take a look at those. But to use the RSI for exits doesn't make any sense. To use it for failure swings makes a lot of sense. You can even micro this into day trading. Minute charts, 5-minute charts, looking at the RSI, looking for failure swings. It works. It's you're not going to get indications all the time. You're going to have gaps, right? And so you're going to have these periods of or just no data filled in, like yesterday. All right, let's get a stock that actually has the data filled in for yesterday. Looks like Stock Charts doesn't want to have the 5-minute data for yesterday. Let's see if any stock. No, they don't have the 5-minute data for yesterday, but we could come into something like Thinkorswim or something like that, bring up the RSI and the 5-minute data, whatever charting service you're using, and you'll see failure swings come in. From time to time. Now, when you're going this short term, you have to ignore the gap, right? You have to ignore this kind of first hour and let the chart reset. Let it get 14 periods away, right? And so if we're using a 5-minute chart of 5 minutes times 14, that's how long I have to wait. So a little bit more than an hour, an hour, 10 minutes. I have to wait until the chart, resets, gets rid of this gap, that creates a big up or big down or some, misread in the indicator. But after that, it works, just fine there. So failure swings with the RSI, by far the best use if you're looking to use it from a trade standpoint. If you're looking to use it from an investor standpoint, change the indicator. What do I mean? Well, if you're looking to use it from an investor standpoint, 14 days, that's pretty small. Back that out. Put on a 28-day, right? If you're just looking for trends in the indicator, longer-term trends in the indicator, back it out to 28 days. You're going to see fewer actions, fewer elements coming into play, but you're going to be able to see the divergences better. You're going to be able to see the failure swings. Really, they're going to be dynamic when they happen. So if you're a longer-term trader, that's all you have to do. Back it out. Back it on out. But for most stocks, it's going to be like AT&T. Yeah, stock goes up, RSI is going to go up. Stock goes down, RSI is going to go down. Yep, okay. Stock hit a new low. RSI didn't hit a new low. We have bullish divergence here. Okay, stock goes up. All right, hits a new short-term high. RSI goes up, not really telling us anything. Now we get this sell-off. Okay, RSI hitting a new short-term low, confirming, the sell-off, but no divergence there. Then what do we get on this next sell-off? RSI, same level. Right, so we have positive divergence right here saying, all right, chances are next wave is up. So you'll get some of this here in the indicator and be able to kind of track that. What is it telling about AT&T right now? Absolutely nothing. We have no divergences, right? We have the stock basically has been rising, so is the RSI. We had an earnings gap. The RSI came down, sitting here around 50, which has kind of been its midpoint for a long time. The RSI is not really telling us anything, and it's probably going to be a long time till it does tell us something. So not my favorite indicator for, just everyday use, but to look for those failure swings as you're going through your watch list, you see some of those come into play. That's where it gets dynamic. That's where it gets very tradable, and that's where the short-term trade elements kind of start to come into your favor and start to say, hey, you know what, this is set up. Take a look at Microsoft, right? Microsoft does not have a failure swing, right? Here, Microsoft came on up, moved on up, overbought, pulled on back. The next time it pushed above 70 was right here. But notice how it's now gone to a new high. So this action back here no longer matters. But now we have a new high. Here's the RSI all the way up here. It's now broken down below 70. That's not the bear signal, right? All that is a pullback, just like right back here. That's all it is a pullback. But let's say Microsoft rallies tomorrow. The RSI pushes above 70 and comes up here to about 75. And then 2 days later, the RSI breaks below today's low. That's where we have a failure swing. It's going to take several days for that to develop, and it may not ultimately develop. But if you're looking and say, hey, I want to put Microsoft with a failure swing, hey, it's a lot closer than it's been now for a long time. Right? Microsoft hasn't been in danger of a failure swing in a very long time. But now it actually has some of that element coming into play. Right, and when you look at stocks in general out there, you look at a lot of the different equities, out in the market right now. There are a lot of these elements, kind of shaping up, kind of setting up out there, where you have some of this kind of failure swing stuff. FedEx, not quite a failure swing, a full-on failure swing right here, but was fairly close, right? But RSI below 50, just kind of moving with the stock. But a lot of these stocks that are kind of near the tops and whatnot, setting up for them. Here's one, Apple. This one, is setting up for a potential failure swing. It hasn't had one, right? Here we go. We get the RSI above 70. We get the pullback, right? Then it goes back up. RSI never gets down below this point, right? Before going and hitting a new high. Once it hits a new high, all this back action doesn't matter anymore. Doesn't matter. But now we have a new high. We've pulled back below 70. We've pushed back above 70. Now we're breaking back below 70. This low, from what we saw last week on the RSI, that breaks. Short Apple. Ride that downtrend and go, right? That's what it would need to have a failure swing. We don't have a lot of stocks with bullish failure swings right here, but here you can see on Apple, the bullish failure swing set up right here, for Apple, right? Had one back here in December, January. We have no bearish failure swing right here, no bearish failure swing right here, as they were equal levels. But we've had one in a year. We've had one bullish failure swing. That's it, right? So for most stocks, that's going to be, most stocks are going to have 2 to 3 in a year. But, it's not something you look at as an everyday type of thing. But when you see it happen, when it takes place, it can be pretty darn powerful. And it's my favorite use of the RSI. So RSI, great indicator. Strongly recommend understanding the RSI, not to go use it aggressively and to, say, hey, I'm going to use this all the time. But if you can understand the RSI, you can now start to understand the story behind a lot of other indicators. What's the story with the RSI? Is it overbought? Is it oversold? Is it trend? Right? There's not this huge story with it unless we see divergences. Divergences are where the story comes into play, and we understand, okay, RSI for divergences, which divergences generally indicate an upcoming change in trend, right? Upcoming change in trend. And that's it. And that's the RSI. Thanks for hopping on. Have yourselves a great one, and we'll talk to you later. Take care.